Hello, everyone. Hope you guys had a spectacular weekend. Happy holidays. I hope you guys had a lot of rest, spent time with family, but now the market is about to open. So we have to equip ourselves with the knowledge necessary to tackle this week in the stock market and end the year off beautifully. All right. And that's exactly what we're going to do. We're going to end it with a very, very strong note. In today's video, we're going to talk about the next steps for the stock market. We're going to go over some recessionary signals that I see in the market that everyone needs to be aware of as well. If you are new to this channel, congratulations. You have just entered the best YouTube channel for finance, period. I'm not one of these YouTubers. Just even calling myself a YouTuber just sounds disgusting, but I'm not one of those people that makes YouTube videos and say, oh, well, we're currently in a downtrend. The market is going to continue falling. The people that are following and watching these videos and a part of the community are making tens of thousands of dollars every single month. I share all of my trades and education, everything live, completely for free. There's no one else doing this in the industry on YouTube, nothing like that. There's no one else doing that. I don't share my BS watch lists and my commentary. All of that stuff is completely useless when you're not applying it to anything. So I'm not one of those people, oh, wow, well, the market, it's currently really, really weak. No, I give tangible buy and sell signals. You don't need to, obviously, you should not be following them. I'm not your financial advisor. This isn't financial advice. But the education, the seeing what a profitable trader, options trader is doing is invaluable information. And I'm the only person doing this online for free. So yeah, welcome to the community. So yeah, to wrap things up, in the Discord server, for example, we have a lot of trades. This is just my daily recap channel. People make a lot of money and it's working out really, really well. So if you guys want access to that server, the Discord link is going to be in the channel description below. Definitely make an investment in yourself. And if you don't want to join the Discord, that's your loss. But regardless, I go live on YouTube and Twitch, everything live completely for free. You could just tune in. You could literally watch me trade live. You could, if you really, really want, you can look at all of the replays of all of my streams on YouTube. They're still saved. So you could sit, you could watch me making money live and sharing it live completely for free. So enjoy that. Welcome to the community if you are new, and let's get this started. So we've all been hearing how hundreds and hundreds of CEOs are all saying that there's going to be a recession very, very soon. And this is for good reason. So this is an article from the Federal Reserve Bank of St. Louis. And this is basically giving us an indication and correlation between yield curve inversion versus unemployment rate peaks, right? So basically what it's showing is that when the shorter term yield that the US gets, right? So for example, when the 2-year yield inverts and starts paying more than the 10-year yield, that is a sign of a recession and a large spike in unemployment. So what this basically shows us, this table here, is that, so this column basically shows the inversion of yield curves and when they happened, right? And then this column shows how many months after the initial yield curve inversion happened that we saw a peak in unemployment, basically. And you can see that the longest time that it took was 16 months. So now, recently, all right, so very simply, this is a chart of the US 10-year yield divided by the US 2-year yield. Generally, when you're investing in a company, all right, in this case, the United States government, the longer term yield should always give more money because you're expecting that the US economy should continuously grow over the coming years, right? It becomes a problem when the short-term yields pay more money because it means that there's a lack of stability or a lack of comfort in the longer-term outlook of the US economy. When that happens, that is basically signaling a recession. And we first saw the US 2-year yield and the 10-year yield invert back in April of 2022. Okay. And of course, according to this, we remember that 16 months after historically is the peak for unemployment. So very simply, if we were just to do some simple math, April 2022 is when this happened, right? when is the longest time after April 2022 that we should see max unemployment? Basically, max unemployment coincides with a very, very big drawdown in stocks and a recession, right? So stocks should fall much, much lower, according to this, right? So April 2022, what's 16 months after April 2022? So April 2022 plus 12 months is April, right? 23. So then April, May, June, July. So then you basically get July of 2023. That is when we should see a big drawdown in the stock market. So now another issue is that things are starting to heat up even more internationally. So you could see German futures taking a hit, right? Obviously, this is weak. Same concept for the Japanese market. Same concept for the other markets as well. Not as much with the UK market, but now when we look at the yields of these, the German market, for example, the 2-year yields on the German market and these other 2-year yields are skyrocketing very, very abruptly. So this is not a great sign, obviously. The reason for that is because on the short term, these countries' shorter term yields should not be giving that much yield compared to the longer term. But the fact that they are now is a recessionary signal. And the fact that other international governments' yields are starting to, the shorter term ones are starting to do this is another bad sign, you know, depending on how you want to look at things. But yeah, this is just one example. So you could look at the UK 2-year starting to perk up a bit. And then you could also look at the Japanese 2-year as well, really starting to skyrocket. And then when we look at the US 2-year, it's starting to break out of its downtrend with this green candle here. So the US 2-year yield, you could see that it's paying 4.32% as opposed to the 10-year yield. It's 3.7%. So the 10-year yield is paying less money, yet less percentage yield than the closer term yield. So basically, as the shorter term yields are skyrocketing, the stock market should be falling. All right. That is basically the larger term premise here. Okay. So now when we look at the overall market, it's about to be January of 2023. July of 2023 is basically 7 months away. And basically, we have 7 months to hit, historically, 7 months to hit max unemployment rate. So we still have all this time. Basically, this is July. There is still a lot of time left before anything really can happen. So statistically, right, it makes sense to be going short, especially knowing what happens when recessions do occur. The stock market ends up falling even more. So all of these are good opportunities to get into longer term puts. 2024 puts, 2025 puts would be probably the safest bet. So yeah, basically any sort of time that we get a big movement up, according to statistics, is a good opportunity to go short. Now, that is not the case if the Fed ends up pivoting and if the Fed ends up printing more money, et cetera, then this entire concept of a much bigger drawdown will, in the short term, be subsided. The worry would be subsided. But until the Fed basically steps aside and starts printing money again, the downward trajectory is still very, very apparent. Okay, so let's zoom in and just take a look at what's going on in the SPY immediately. All right. So currently, right, they sort of just mess people up towards the end of the week. And historically now, we're entering a time where the market ends up rallying towards the end of this week. Usually the market rallies between Wednesday to Friday sometime. And now the question is, we're just very, very simply, we're in a range. And unfortunately, this isn't the most clean range to be in. All right, 375 to basically 388. All right, 375, 388, it's 13 point. So to get a really, really solid break of either of the range, high or low, would be it would be an easy trade to take. But of course, also we want to see which side the momentum is going to be on. All right. If we can start showing some strength, then we can play according to the levels of the range. So for example, another trade would be if we bounce and we get to 388, we can go short against this upper range here. But yeah, regardless, overall, according to what we just saw, everything like this, even if we do break above, even if we hit 420, 410, 400, regardless, unless the Fed has not pivoted, these are all good opportunities to get into long-term puts, because according to statistics, we have another basically 6 months to get maximum unemployment. And once we get maximum unemployment, the stocks and the stock market should have fallen much, much more. So have money left aside to buy the dips, especially on very, very big moves down, especially if we start falling down below these 350 levels. And if we get down to like 300, 320, first of all, you know, you don't want to be left out, and you don't, like, now is the time definitely to start scaling to some sort of puts. But once we get down here, then it becomes the time to really start scaling into some longs, because now if we take a look, if the percentage drawdown, a 30% drawdown from here, that's if we get a 30% drawdown, would be 260. But down to 300 is only another 20%. So that's still very possible. But yeah, I just want people to have that in mind. And yeah, this is just very, very important. One of the things I want to take a look at was Tesla. So Tesla is taking a very, very big hit. If Tesla can start showing some strength, Tesla might end up helping the market up a bit. But you could look at all these large tech stocks and everything. They're all taking hits, but they're starting to bottom out. So we need to see if there's going to be more follow through to the upside, especially from these tech companies, because a lot of these tech companies are starting to show bottoming formations that can last at least a day or two to the upside. So we need to see if, you know, heading into this week, if we could end up playing that to the upside, basically. So this is also a chart of the 30-year bonds. So there is a correlation, basically, when the bonds are going up, the stock market is also going up. Currently, we can see that the bonds are starting to break down lower and start showing a lot of weakness below levels of support that were being held. So if we start really, really churning down below 126, all of these levels of support, I mean, obviously, this is not a very, very good sign for the stock market, seeing that the bonds are starting to show weakness, right? So yeah, we need to just see if that weakness is going to continue permeating into the overall stock market. The rates are basically leaning to the next few months, especially basically the beginning of the year. Within the first 2 quarters, historically, there should be a recession. So it's going to be very, very interesting to see basically what happens in terms of the overall stock market and everything. But yeah, the best we can do is go based off of statistics, manage our risk properly, enter and exit the market in a safe, intelligent manner, and yeah, make money and not make stupid decisions. So regardless of what direction the market is going to go, we're going to make money regardless. So yeah, hope you guys enjoyed today's video. Make sure to like, comment, subscribe, do all that good stuff, and I will see you guys bright and early tomorrow morning. Thank you.